Let's get a quick handle now on what's happening in the F&O world. Ashish Chaturmutta, the Director and Head of Research at JM Financial Services, joins in. Ashish, good morning. The market has had 6 days of a fall. Do you see a respite coming through, and is it sustainable? Also, what are individual stocks that you're looking at today?
Hi, good morning. So I think, see, broadly, after 6 days of correction, now we are seeing a gap up opening, and SGX is indicating a good gap up, that too on an expiry day. So clearly, on expiry day, if we see a move towards 17,000, it is going to, force a lot of this, call writers to cover up their positions, because, yesterday we breached 200-day moving average, and it forced a lot of, new traders to create short positions into call options. So I think now that position is going to get stuck into the market, and if we sustain about 17,000 levels in the first half hour of trade, then I believe that there could be a short covering. Although we firmly believe it's going to be more sell on rise market, but definitely in a shorter term, a pullback towards 17,200 to 17,250 could not be ruled out. So yes, next 1 to 3 days we expect some kind of pullback or recovery into the market. But keeping that in mind, I think some long ideas and short ideas we are creating. So on the long side, we feel that SRF is looking quite good after 6 days of correction. We are seeing a very good interest in the fluorine based players. So we have seen Gujarat Fluoro saw a very good rise in the last couple of trading sessions. Now SRF, after 6 days of correction from 2,800 to almost 2450 kind of trajectory, we feel that one can initiate a long in SRF with keeping 2420 as a stop loss. On upside, 2650, 2700 could be short-term target one can witness in SRF. Eicher Motors is looking very strong despite the sell-off we have witnessed in the broader market. This stock failed to even breach the 20-day moving average, and we have not seen any significant liquidation of long positions in Eicher Motors despite the sell-off we have witnessed in most of the other auto players. So I think this could be bought with a stop around 3,500 on upside. 3,800 would be my short-term target in Eicher Motors. In the defensive basket, I think Dr. Reddy's has given a very strong breakout after consolidating for good 6 to 8 weeks time frame. And in yesterday's trading session, we have seen good build-up in Dr. Reddy's, DB's Lab kind of pharma names. So Dr. Reddy could be bought with a stop around 4,200 on upside. 4,360 would be my short-term target. And on the sell side, Bharat Forge is looking very weak. Stock has given a breach, below 7-8 weeks consolidation with good amount of short buildup. So keeping 718 as a trading stop loss, one can initiate a short in Bharat Forge. On downside, 650 would be my short-term target in the stock.
Okay, thanks a lot, Ashish, for that. Well, we're just counting down to the pre-opening rates. Some of them are kicking in. It's not such a bad showing, actually. The Nifty is fine. I mean, there's not such a big pullback as the SGX was suggesting, but trending a tad bit in the green as of now. Let's see. For now, it's been a bit of a downtrend the last 5-6 days. Doesn't look like any major pullback is coming through, at least at the moment. We'll wait by for these rates to settle. Rajesh Bhatia is still with us of ITI Long Short Equity Fund. Rajesh, if I remember correctly, you've been quite bullish on the auto space, and now we are seeing demand come through thick and fast. Some of the supply side raw material issues are also being ironed out. Is this a space that's good to go for more?
The valuations have certainly, become a little more expensive. So the risk return is a little more fragile there. I think the good thing is that a lot of the 3-4 year challenges that the sector was seeing, that is behind the entire sector. But now we must realize that autos are also play on the economy. And given where valuations are now, volumes better not disappoint. So as long as the volume trajectory picture and outlook is good, I think the auto sector could continue to do well. Particularly, I would say premium two-wheeler category is strong. Tractor SUV category as a portfolio is very strong, and commercial vehicles are another space which is very strong. So great that they've gotten through the multi-year challenges that they've been seeing, but now it requires volume growth outlook to continue to remain positive for valuations to support stocks here.
Rajesh, just to kind of pull back to the earlier point, the broader point about the fact that what you made, which is there are vulnerabilities with the macro picture here in India. But does all of that come into play only and only if oil prices start to jump higher meaningfully? Or you think, I mean, even with just a global slowdown and oil prices around here, some of these start to get exposed? What's your sense?
No, Prashant, actually you make a good point, because oil is, if oil goes up, then I think all hell will break loose in India, because like I said, these 4% CAD, etc. is there with oil being benign. I mean, if oil goes to $120, $130 plus, then there is even more trouble, for India to manage our inflation and manage the CAD, etc. So this is even without the oil prices going up significantly. And there is a good case for oil prices to go up, I think, given the underinvestment, given the low inventories globally, and yet given the demand traction in oil. So there's a good case for oils to kind of move up, but this is even without that. See, we must remember one thing, that there has been an outsized increase in interest rates globally, and we are not done there. So given the outsized nature of interest rate increases, it's very difficult and naive to believe that we will not have a hard landing in, let us say, countries like US or Europe, UK, China are already in a tight spot. So given the outsized nature of interest rate increases that are taking place, it would be naive to not believe that there will be a hard landing. And certainly that will have an impact on our growth as well.
Rajesh, we'll leave it there today. Thanks a lot for joining us. Good chatting with you as always. And bring some more movie anecdotes next time as well. We'll discuss that as well. For now, the market has started to settle in pre-open on the higher side. As Sonia mentioned, not near the SGX Nifty levels yet, but then we'll give it some more time. It's 9:05. The pre-open settles, remember, at any random time between 9:07 and 9:08. Aarti Industries is a stock in focus. It will demerge its pharma business into a separate entity. The record date for demerger between Aarti Industries and Aarti Pharma Labs has been fixed on October 20, 2022. To discuss this and other issues, we have Rajesh Gogri, Vice Chairman and Managing Director at Aarti Industries, joining us. Rajesh, hi, good morning. Thanks for joining us. So all approvals in place. That means we'll have two separate listed entities. And when will the demerged entity list?
Yeah, so the demerged entity will list, post filing with ROC within 60 days. So that is likely to happen around mid of October. So it will be mid of October plus 60 days. So it will list around mid of December.
Okay.
Okay.
All right. So the listing timeline for the demerged entity is mid-December. Can you tell us what kind of growth are you expecting in both the segments separately after the demerger?
Yeah, as you know, we have been, guiding that both the sectors are doing well, and particularly the chemical sector, we have given a large capex guidance, and also the growth guidance in terms of top line and bottom line of 1.5 to 2x for last 2 years, for 2 years going forward. Similarly, in pharma segment, also we are looking at 15 to 20% top line growth and also the bottom line growth, and both the segments are doing well going forward.
So in the chemical sector, you said there's a large capex guidance. How much money are you putting on board, and what would the growth be for the chemical sector?
So in combined, we had guided for last year we had guided for a 4,500 to 5,000 crore capex combined, out of which, chemical segment will be doing a large capex for 4,000 to 4,500 crore. And, the guidance, revenue guidance is, up for FY27 is 2.5 to 3x in terms of EBITDA. It is 3 to 4x, and profit after tax also 3 to 4x. So we are continuing our guidance for the chemical segment.
Okay, let's talk about the chemicals business a little bit, Mr. Gogri. Hi, good morning.
Good morning.
There is some concern that margins for mostly commodity chemicals, right, have started to fall. Can you tell us what has happened so far in the second quarter?
Yeah, see, the overall what is happening is that the prices, raw material prices have started declining, particularly on the back of lower crude oil prices. The raw material benzene and other raw materials have started coming down. And, that will result in little bit of destocking at the consumer end, and which will result in some pressure on the pricing. But however, we feel that this is a shorter term phenomenon, and once the prices stabilize, then we will be able to maintain our margins in the products.
So can you tell us on nitric acid itself, which is one of your raw materials, what is the current pricing? I mean, there was a sharp rise in prices, and how have you managed that price increase?
Yeah, in the nitric acid, we have a long-term contract, ongoing contract. So, it's a raw material linked contract. So for us, it's basically the raw material fluctuation which gets affected, and raw material essentially is the ammonia, which is linked to natural gas. So we are not in a spot market where we buy. So we are insulated by the market movements. But however, the market went, spot market went down from 65 to 55 per kg in concentrated nitric acid.
All right, Mr. Gogri, we'll leave it there today. Thanks a lot for joining us. So that's Aarti Industries. Record date has been fixed. The demerged entity lists somewhere in middle of December. So, of course, the adjustments will happen in October. It's an F&O stock, so there will be the contract adjustment as well, which will happen in October. So, something that you will have to keep in mind while trading the October contracts of Aarti Industries. Let's take 9-10 calls. Then the pre-open has settled in line with what the SGX Nifty was telling us, somewhere around the 17,000 mark, 16,993 to be precise. Remember, 17,000 call has huge open interest and 17,100 as well. So that's going to be the big resistance zone on a gap up, and the Bank Nifty is opening 333 points higher. Sudarshan, if we open here, do you trade the index? And what's your 9-10 call?
See, if we open here, we can't trade the index. We go short if the Nifty has a rally between 17,100 to 17,150, which is an ideal location to sell into. Berger Paints is the buy with a stop under 622.
Berger Paints, okay. Mitesh, your 9-10 call?
No, I'll go with the buy on Asian Paints. I think very clearly breaking into fresh highs, this stock should do well. Keep a stop at 35.40, 36.50 should be the first target, so it can be revised on the upside.
Fair enough, gentlemen. Thanks for that. Let's discuss some more stocks then. Sonia, you're watching out for Tata Motors.
Oh, you know, yesterday there was a launch of the Tiago electric vehicle, right? And it's the first sub 10 lakh rupee EV from the Tata Motors stable. So there was so much excitement around that. And brokerages are also quite bullish on Tata Motors because of that. In fact, the stock is the big mover this morning. The Tiago has been launched at an introductory price of just 8.5 lakh rupees for an EV. And Jefferies says that they have a buy with the target price of 540. They say that it's a very reasonable price. It's an attractive price at which it's launched. And Tata Motors is expanding its EV availability from 85 to 165 cities now. EVs currently form just 8% of Tata's India passenger vehicle volumes, and there is potential to gain more market share there. Nomura also has a buy with a target price of 520. They say that Tiago EV has the potential to become the best-selling EV in India. In any case, the Nexon is the best-selling EV currently. The total hatchback segment sells 44,000 units per month, and Tiago EV is expected to sell about 5,000 units per month. So that will definitely give a big fillip to Tata Motors and to the stock. And it's a pretty good car. I mean, I don't know about the looks, etc. Some people are not too happy, but the pricing is on point.
On point, absolutely. I mean, actually, I was reading that they already have a EV. This is the first EV product in that line, in that category.
So they have the Nexon, and then the Tiago is there currently. The petrol, the petrol. Now they've moved to EV. In that.
I see. I must be getting it mixed up. There's a ride-hailing company, EV ride-hailing company called Blue Smart. And I was reading that they are, I mean, actually, most of their bulk of their fleet is made up of Tata Motor EV vehicles.
Yes. So right now, it's only South Delhi based, so obviously they'll expand.
NCR, and I think they've just entered Bangalore as well. So it's, by the way, part of the listed entity. It's, I think, Gensol Engineering, with the stocks gone absolutely berserk. GCPL in focus, just revisiting it. Mangalam is here with more. Mangalam.
Well, the reason why Godrej Consumer is in focus is because they held a conference call with investors over their Africa business. The key takeaway was broadening portfolio of products that they have to offer in Africa will be the next leg of growth. Remember, the business has grown in double digits over the last 8 quarters. So that is something that has the brokerages excited. We have comments coming in from Jefferies, Credit Suisse, Edelweiss, as well as Morgan Stanley. All of them having buy overweight ratings on the stock. with target prices ranging anywhere between 975 odd rupees to over 1100 odd rupees as well. But apart from Africa, the next half of this year, the second half, we do have lower palm oil prices and festive demand as key triggers for the company. The only important things to watch out for going forward will be how they improve their Indonesia portfolio, the business out there, and household insecticides, which has been a bit of a problem for the company for the last many quarters. So if they improve those two parts of their portfolio, perhaps, the street would like it even more. And which is why also, the stock trades at a bit of a discount to all the others in the FMCG space at around 37 times FY24 earnings.
All right, thanks a lot for that. That's on GCPL, but there are some standout brokerage reports this morning as well. Nimesh has the list for us. Nimesh, over to you.
Hi, Sonia. Good morning. So today's standout is on specialty chemicals. A big report from Morgan Stanley, 55-page, and they've made some big changes. So the first is they've double upgraded Tata Chemicals to overweight from underweight, and they've sharply raised the target price to 13.19 now on Tata Chemicals. On the other side, they've sharply downgraded Aarti Indices to underweight from overweight and cut the target price sharply to 685 versus the other target price of 957. They've also downgraded Deepak Nitrite a notch to underweight from equal weight, and there they've cut the target price to 1732. But SRF remains the top pick for Morgan Stanley in the chemical space, and over there they've sharply raised the target price to almost 3571 now versus the earlier target price of 2757. So a big upgrade in terms of target price on SRF. Now, key reasons for the changes on downgrading Aarti Industries. The key reason is it's reflecting the material constraints and slower ramp up in terms of their capex. So that's the key reason for the big downgrade. On Deepak Nitrite, they see limited visibility on phenol and demand risk in the key segments for Deepak Nitrite, hence a downgrade. On Tata Chemical, though, the big upgrade to overweight is back largely on back of sustained tightness in the soda ash and better cost controls by the company. So these are the few reasons for the upgrades and downgrades. Overall, on the sector, on specialty chemicals, they see a $25 billion opportunity, and hence this big changes by Morgan Stanley today.
Nimesh, thanks a lot for that. The first rates are in. The Nifty is opening above 17,000. 17,020 is what you have. So let's see if it can build on to that or not. The Bank Nifty is open 400 points higher. The mid-cap index is open higher. 49 out of 50 Nifty stocks are in the green. The only loser is Asian Paints. And that's maybe because crude's gone up in line with the other asset classes. But the risk-on stocks, both Tata Steel and Hindalco, are up to 2.5%. Tata Motors is up about 3%. The Nifty is now slipping just below the 17,000 mark. So will be interesting to see how things pan out. ONGC, Mahindra, IndusInd Bank, Bajaj Finance, Sun Pharma, HDFC, SBI, ITC. So across the board, there are gains that you're seeing right now. As I said, there's only one Nifty loser. But really, the global-facing stocks are the ones which stand out. Tata Motors, Tata Steel, and Hindalco. That's because of the global risk on, as I said, and the dollar play. What else? Bajaj Finance and ICICI Bank helping the financials. Reliance is doing well today. Reliance yesterday ended at low point of the day, but today at least it's starting higher. Overall, good-looking screen, 17,000. Once again on the Nifty. Sonia, over to you.
Absolutely, and very good start for the mid-cap index. By the way, Nykaa is up about 5%. And the company will be considering a bonus issue on the 3rd of October. So that's got the stock very excited. Ramco Cements, it has commissioned its 5th integrated cement plant in Andhra Pradesh. And it has a capacity of over 2 million tons per annum. So keep an eye out on that. A couple of others, Adani Transmission, Adani Wilmar are all doing well. Tata Chemicals, Nimesh was just talking about the Morgan Stanley double upgrade on Tata Chemicals. That one is up over 3% right now. Patanjali Foods has been doing well lately. That one is in the green. Talking about green, Adani Green is doing what it does best. It's actually recovered a tad bit. The last month was not too good, but now it's up almost about 2-3%. Then you have something like Tanla Platforms, RBL Bank, Bharat Dynamics once again has resumed its uptrend, Borosil Renewables, Campus Activewear, PVR. So these are stocks that are doing pretty well. A lot of gains in the banking sector, by the way, 424 points in the green for the Bank Nifty. So that one is also looking good. Torrent Pharma, let's see how that one's looking. The US FDA has inspected the company's manufacturing facility and says none of the observations were related to data integrity issues. So that's, of course, green for them, up over 1%. And Blue Dart has raised prices. I mean, they will raise prices from the 1st of Jan with an average price hike of 9.6%. So Blue Dart is in the green right now. Otherwise, very green today.
Very green. And yeah, I mean, it's looking good overall, isn't it? Some 1,700 stocks are higher. It's just 2 minutes into open, so I guess too early to look at the market breadth, but it's up. and about. Adani Wilmar is up 3%, 757. There is Hindalco, which is up about 3.25%. Adani Green is up about 3% as well. Tata Chemicals is starting about 3.5% higher. Nykaa is up 4% on volumes. There is Adani Transmission, which is up 3% as well. So I'm spotting 3 Adani Group companies, in the top gainers list in the top 10 with volumes, by the way. So that's the list I'm reading out from. There is Patanjali, which is up about 3.5% as well, 1379. What else? LG Equipment is up 4.5%. But then you go down the list and volumes are starting to thin out. It'll pick up in just a bit. And we'll revisit these. Asian Paints is down 1.5%. Asian Paints, I think, did well yesterday. It was up about 3%, so giving back some of that today. And what else? India Cements is down about a third. Deepak Nitrite starts flat. Aarti Industries, we just had the management with us. It's starting down about 1.25% or so. So mild moves, small moves overall. As far as broader market is concerned. 150 points for now, 17,013 is where the index finds itself at. Our market master of the day is none other than Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, great to have you with us here. It's a pleasure having you with us here on CNBC-TV18. Nilesh, I remember you as a bond market veteran as well. I mean, what we saw over the last 3-4 days out of the UK, just amazing stuff, right? As an observer, I mean, not in terms so much as implication or anything, but just amazing last 3-4 days. Any thoughts?
So as Lawrence Summers wrongly put it, UK is behaving like an emerging economy. I would like to correct him, and I will say UK is behaving like a developed country. Their behavior cannot be attributed to emerging market economies whose currencies have remained strong, whose fiscal position has remained better, whose inflation is lower than American inflation. So sorry, Mr. Summers, you need to be corrected.
Nilesh bhai, good morning. I thought you for a moment will say it's behaving like a underdeveloped country. Okay. No, okay. Anyway, but India has been quite resilient, Nilesh, and yes, in the last few days we have participated on the way down. But even then, point to point, there's still outperformance, right? And the US market is at 52-week low, a couple of other markets at 52-week low. And we are actually, at this point, still closer to 52-week highs than lows. So you reckon this outperformance could continue?
So the extent of outperformance could narrow down. There is a massive global sandstorm blowing out. We are like an oasis in the desert. But if sandstorm passes through us, some sand will be deposited. So I do believe India is in a better shape vis-a-vis others. We have some challenges like our external position to take care of. But once the sandstorm is over, people see that India is truly an oasis in the desert.
Nilesh, hi, good morning. I remember when we chatted in the month of August, you had said that, the global slowdown is exacerbating and perhaps the markets need to pause a bit. Since then, the market has taken a turn for the worse. I mean, we're off about 7-8% from the highs. Do you think it could get worse before it gets better? And if it does, what should the best strategy be for investors? Continue putting in money in every dip? Or just keep powder dry for a bit? You may get a better opportunity perhaps over the next few months.
So Sonia, I know the beginning of the movie and end of the movie. The beginning of the movie is like a horror movie right now, where interest rates are being raised, liquidity is being sucked out, albeit grudgingly, which has impacted demand, which has raised inflation, and which has kind of knocked down growth. And that's reflected in both debt and equity market globally. I know the horror movie, if it wants happy ending, we will require central bankers to go back to providing liquidity, cutting interest rates and supporting growth. Now in United Kingdom, Bank of England on one side was raising rates, on the other side it intervened in the market to provide support to the falling gilt prices, and in turn provided liquidity. Probably that's the reason why stock markets are up, because markets are expecting that central bankers will walk left and talk right. Now, I don't know when the intermission will begin and when the central bankers will switch the role. Will it be like Bank of England or will it be someone else? So clearly, we are at a stage where there will be volatility in the market in both the direction, up as well as down. If yesterday afternoon you had asked me what will be my view on the market, 99% I would have said I don't know, but 1% I would have betted that it will go down. And today it is up because of Bank of England action. So the best thing for investor will be to buy on dips. We are indeed an expensive market vis-a-vis peers on a 1-year valuation. And we are indeed a cheap market vis-a-vis peers on a 5-year valuation. So be a long-term investor. Use this correction as an opportunity to build your portfolio, albeit with a longer-term horizon.
Well put, and nice movie references, Nilesh. To talk about IT services, Nilesh, what's your sense? It's one large group now in the market which is significantly off. Would you bet on longer-term prospects staying strong? The move to digitization, etc., is a secular theme, not just here but around the world. But of course, I mean, it comes down to what price you pay for it, right? Have prices corrected enough, according to you?
So absolutely rightly said, Prashant. The prices have to reflect fundamentals. And with the benefit of hindsight, we can say that especially small and mid-cap IT companies' prices had run up way ahead of fundamentals. Now those corrections are happening. We believe over next 3 to 6 months is accumulation time for IT sector. The margin pressure on them because of salary increases will get reduced significantly. We have started seeing companies talking about moonlighting, bringing workers from home to office. This would not have been possible if they were sure that the pressure on salaries and wages or the employment will be reduced. Second, rupee depreciation will marginally benefit them. There's no direct correlation between rupee and IT companies' margin, but there is always some marginal benefit here and there. And the third thing, as prices starts reflecting about 8 to 10% revenue growth, I think IT sector will be worth investing into.
Sector which is running away right now, specialty chemicals. Just look at some of these names that Nimesh mentioned in standout. Both Tata Chemicals and SRF are up 3 to 4%. So big moves happening in this space. Nilesh, this is a space which has made so much money for investors, right? And at every level, I've asked this question that is the structural story still intact? You have been an early investor in some of your schemes in some of these specialty chemical names. But you tell us, is this a structural bull market that will continue?
So, Anuj bhai, we have been lucky enough to identify chemical sector when it was just turning around. And we still believe there is a miles to go in this journey. Rupee depreciation has made Indian chemical company even more competitive than what they were. They are now investing in 1 year in fixed assets, what they have invested over 30, 40 years. They are emerging as a preferred buyer or buyer of choice. And especially the European crisis on energy side is impacting chemical production over there. Put all these things together, while one needs to keep a watch on the valuation, but chemical sector today is, like India, on a 1 year basis, it looks expensive. On a 5-year basis, it looks very, very cheap.
Just wanted to come back to that point that, Prashant started the interview with about what Bank of England did, right? Just referring to a tweet from Uday Kotak that came in a while back where he says that Bank of England does an about turn and buys gilts, which is printing new money. Till now, it was tightening to control inflation. Are markets sensing that developed world central banks may not really have the stomach to fight inflation? What does this mean for a market like India? Because clearly, our Reserve Bank is making all the right moves, while you can't say the same about the developed world. From an FI's perspective, do you think that over the course of the next 6 to 12 months, there could be an outsized amount of flows into emerging markets like India purely because of what's happening globally? Or is that a very simplistic way of looking at it?
No, Sonia, that's the absolutely right way of looking at it. India today reminds me of a super lean advertisement मेरी कमीज इसकी कमीज से सफेद कैसे टाई. The world is wearing black shirt. Our grey shirt is looking far more whiter than before. And there are a couple of advantages in India. This time, people have realized that exit from India is easy. You want to sell $8 billion in a stock, it's possible. You want to take out $35 billion in about 10 months, it's possible. But entry is difficult. What you have sold, you want to cover back, you end up paying higher premium. Second, growth story of India. This is one country which has moved from 10th largest economy to 5th largest economy in last 8 years. It will become 3rd largest in next 8 years. So growth story is visible. And valuations, well, it's trading at a gold valuation. It's expensive on a 1-year basis vis-a-vis peers, but it's trading at its own historical average valuations. And on a 5-year basis, we look cheaper vis-a-vis rest of the world. So we are, in that sense, having a gray shirt in a world where everyone is wearing black shirt.
Okay, that's well put. I mean, the cleanest house in a dirty neighborhood. I mean, so many other ways to put it, but I think absolutely right in that. We had somebody else, Nilesh, who said who kind of likened this to liquid oxygen. The oxygen being longer-term growth prospects, which keeps us afloat, which refuses to let the market down. But globally there are problems, so the rise is capped as well. So maybe we spend some time here before getting back on. Thanks very much, Nilesh. It's a pleasure. Appreciate you joining in with that perspective as always. Let me just take a quick look at the market, which has come off a little bit for now. I mean, we were up 150, 160 odd points. We're up 118, 120 odd. So 16,975 is where we are at right now. Let me just look at the market breadth overall. It's still super solid. 8:1 in favor of advances. Almost 1,800 stocks are higher, and 200, 214, 15 stocks are lower at this point. So broader markets are doing absolutely fine. Sonia.
No one's using the word cautiously optimistic anymore, right? The optimistic word has been dropped. Now it's just cautious vibes.
No, but I think Nilesh was,
Nilesh is an eternal bull, right?
You've got to get past this hump.
Yeah.
He's a realist. I think even if you tell him that he's internal bull, he'll say he's neither pessimistic nor
an
optimist, just realist. By the way, just keep an eye on the currency, because the open high on the USD INR has been breached. The rupee started with some strength. It's still showing strength, of course, but it will be interesting to see if because of this whole UK issue, and fundamentally nothing changes, right? And if dollar index starts to retreat once again, what happens here? That's something to keep an eye on.
Okay, let's talk about the capital goods space and companies that are present in, the energy segment, in the chemical segment, because there's lots happening there. Thermax is one stock that we're looking at right now. Ashish Bhandari, who's the Managing Director and Chief Executive Officer at Thermax, joins in to tell us how the different verticals are doing for them. Ashish, thanks for joining in. Last time when we spoke with you, you had indicated that demand in the energy segment is very strong. In export nations like Southeast Asia, Europe, how are things looking? Because there are clearly some challenges that are staring at us in the face. Would that sort of dampen demand for you in any way?
Hi, Sonia. Anuj, Jen, Prashant, a very good morning to you and to your viewers. To the specific question on international markets and demand, I would say quite the opposite, actually, because with all the uncertainty that is going around, a lot of countries are looking at having bigger control on their energy supply chains, which means products like biomass, waste to energy, a lot of distributed power solutions, a lot of distributed energy solutions come into play. And that's a relative area of strength for Thermax. So our plants in Europe are fuller and actually beyond production capacity right now. The challenge that we have out there is not on demand. It's actually finding people to do the work and managing input costs, energy costs specifically, which are a big part of producing the goods that we produce.
Right, Mr. Bhandari, could you quantify that? This many countries, this on the export side, energy self-sufficiency. Here in India as well, there is a fair bit of optimism around the core industries, old economy sectors, right? Cement, steel, refinery, many other industries where maybe there is going to be a phase of capex which will set in. Could you quantify that with some numbers? What are you starting to see in terms of inquiries, orders coming in the second quarter so far?
Look, I think on the inquiry side, for the past 4 quarters, we've been reaching one high after another. Yeah. Now we have reached some sort of a plateau, but that plateau is not a kind of a recovery back to 2020 or anything like that. Yeah, the plateau we are talking about is at a high relative to what we have done in the past. So we are seeing consistent demand, we are seeing good orders, and those orders are being backfilled by good inquiries so far. And we are seeing that across industries, good infrastructure. And I would say India's infrastructure story is still intact. I may say a different tune 6 months from now, but as I see things right now, our story is intact. Yeah, we're getting good orders and good inquiries. It isn't growing as much as it was maybe 6 months ago, but it has grown a lot relative to even pre-COVID times.
So can you quantify this for us when you say good orders? In Q1, your order book grew about 40% and stood at 2,300 crores. What is it in Q2 so far? I mean, just trying to understand, what would this mean for your business?
We'll show a healthy growth over last year. We haven't had a single big order to talk about, which we would announce specifically to the street. Despite that, we should have a decent quarter on orders and a decent pipeline going forward as well. Given it's the end of the quarter close, I would hesitate to share an actual number, but we're quite happy with on the orders front overall. Not just domestic demand, but even internationally.
So the reason I'm asking is more than 50% of your chemicals business is dependent on exports, right? And over there, the demand scenario seems to be a bit fragile. Would that put a lid on the order wins?
No, actually, see, on the chemical side, the kind of chemicals we provide, our market share is 4%, 5% in the developing markets we are talking about. And US in particular has been an area of focus for us. And so our story is not driven by slowdown in those markets. Our story is entirely driven by market share, our ability to address certain applications, enter those markets. So that story stays intact. I don't think the macro situation affects us as much. On the Europe side, I do think there is a window of opportunity and we should do better. US has been a stronger market for us traditionally for chemicals, and we need to increase our capability in Europe, especially given some of the geopolitical issues that are going on. That's a window of opportunity for companies like Thermax. We should look to do better.
Mr. Bhandari, you said you said ordering is kind of plateaued. You said, right?
But plateaued at a high. Yeah, you can't be growing 40%. You can be, I guess, but
no, you can't be.
For the businesses that we are, look, I'm jokes aside though. Yeah. We were maybe a 5,000 crore business pre-COVID with 1 or 2 big orders here and there. Last year we breached 9,000+ crore of orders. We had a few big ones, but Q1 and Q2. We are on a good pace without actually any big orders specifically to talk about. So those orders are coming from multi-segment, a lot of our new products and solutions, good growth from services, good growth from build, own, operate, chemicals continuing to build. So I like that kind of growth actually.
Okay.
No, so which means which means what? Which means you will continue to take in the rate of change in terms of the order inflow. That'll be slower. That's what you're saying.
Rate of no. Actually, I'm saying the growth is now slower, but you are at a high, and that's at a high that you really like because these are profitable orders that you can take it. They're not one-offs. This is consistent business that you can drive, which is also in many ways a view into, as I said, India's infrastructure story, because it shows that multiple industries across the board are looking to invest, are looking for green solutions, are looking for efficiency improvement, energy is a big driver for many different companies. And when that becomes a topic of discussion, companies like Thermax come into play.
So, last time you had told us about the solar OPEX business, which the benefits of that would show Q3 onwards. You're expanding that business via the acquisition of Jalansar Wind Energy and Kanakal Wind Energy. Can you tell us what exactly are the benefits? What will it bring to the table for you?
No, it'll be still slow. What I said was Q3 onwards, the revenues will start to show up. It will still be very small for this year. Next year, it will start to build up. But by Q3 of this year, we would have effectively close to 75 megawatts on kind of an OPEX basis that we think we would have as part of our portfolio, which is right on plan to what we had expected. So this is what we have sold. By the time we commission these projects, by the time they start to show revenue, this particular set will start producing revenue in Q3, but we won't finish the installation and commissioning of the 75 megawatts until Q1 of next year. Yeah, so the next several months, and I hope the next few years, will continue to be busy on the solar OPEX portion.
Sure.
And the business will only now start to produce revenue, which is not the end, it is the beginning of that story.
Just a quick question then. You've incorporated a subsidiary, Thermax Bioenergy Solutions, as well. Can you tell us what is the potential that you see here?
Quite substantial. I think bioenergy and solutions around bio-CNG are in their infancy in India. Tremendous amount of potential in taking things like rice straw, which we know is a big cause of pollution in the north, converting that into useful forms of energy. CNG in this case, taking municipal solid waste, cow dung, lot of different kinds of what are today waste, and converting that into CNG. So this particular part of the business will provide technology and EPC for these kinds of projects. It's a JV that we have announced. High expectations, and over the next few quarters, you will start to see both good orders and revenue from this business. As we start to show, we'll talk about them, and we'll show a couple of wins in this particular quarter itself.
Mr. Pandey, just one last point, trying to get some numbers out of you. Between FY17 and FY22, revenue growth for you has been about 6.5%. Margins were about 7.5%. With what you told us, what should we expect? Because the street is factoring in much higher numbers. I mean, revenue growth for the next many years at about compounding at about 15%, margins at about 8-9%. Are those realistic figures?
I don't know about a much longer term, but in the shorter term, I would say, yeah, those are reasonable targets for Thermax. We have a backlog to show. Commodity prices are now somewhat stable. There is no reason to not have those kinds of expectations, and that's what we are performing towards here. There are still too many moving parts, so to call out a quarter by quarter would be unreasonable, but longer term, that's what we are focused at.
Okay, 15% revenue growth, top line growth. Thank you very much, Mr. Bhandari. Appreciate you joining in and taking us through all of that. Appreciate it. Well, the market is back from where it fell earlier. We were back up 150 on the Nifty. It had lost about 40-50 points, but you can see the pullback which has happened. We'll take a quick break and we get back to markets with Vikash Kumar Jain of CLSA, who joins us to talk about, of course, the NPC meet tomorrow. And of course, markets. What else? We're back with him in just a bit later. We also connect with the management of Sundaram Finance to understand trends in the commercial vehicle sector. Stay tuned.